Occupancy and home loans. Occupancy is arguably the most important factor when underwriting a mortgage. It was one of the biggest fraud types leading up to the Great Recession, and because of that, has garnered some strict guidelines these days. Occupancy refers to who will be living in the property you want a mortgage on, and it's important because the risk to the bank varies depending on the occupancy, as well as the terms, such as the minimum down payment, interest rates, and required credit scores. There are 3 occupancy types: primary residence, second home or vacation home, and investment property. The terms for each, meaning the minimum down payments and interest rates, increase in the same order. For example, a primary residence will have the lowest rates and down payment requirements because lending money to a qualified person for their own home is seen as the least risky, while lending money for a second home or an investment property becomes even more risky. Banks believe, and statistics show, that if shit hits the fan, the borrower is always going to make sure that the roof over their head is secure. And if money becomes tight, they'll forego making payments on their second home or investment property in order to keep making the payments on their primary residence. Plus, their full attention and care with regards to maintenance is typically focused on their primary residence, where with the second home and with an investment property, there will be tenants there who may or may not take care of the property. Occupancy becomes an even bigger factor when you start to acquire multiple properties. And occupancy fraud is a felony with hefty fines and even prison time. So be careful and make sure you have a solid written explanation if you're applying for a loan on a new primary residence.